If your money seems to vanish faster than you earn it, there is a real reason. And strangely, it is the exact same reason a tiny $35 a week habit can one day out-earn a full-time job. Time quietly works against your paycheck, but it works just as hard in favor of your investments. Once you see that link, everything about money starts to make sense. By the end of this video, I will show you a simple Fidelity portfolio that is projected to turn $35 a week into nearly $1 million, paying around $8,000 a month. Now, before your excitement runs away, that is a projection over 30 years, not a promise, and it assumes strong returns keep going. This is education, not financial advice. I will show you why small weekly investing beats waiting for a big lump sum, how the snowball actually builds, and the exact funds that keep growing even when the economy feels scary. The secret is not picking the perfect stock or timing the market. It is consistency, the one financial move almost anyone can actually control. Stay with me, because the part most people get wrong is thinking small amounts are too small to matter. Let us start with why your money feels so tight in the first place. Most people hesitate to invest weekly because $5 or $10 feels too small to matter. But that feeling comes from a squeeze you live with every day. Look at food. Prices have climbed almost every year since 2020. Around $20 of groceries back then costs roughly $25 today. Borrowing got more expensive too. Interest rates went from near zero in 2020 to around 4% by late 2025, making mortgages, car loans, and credit cards heavier every month. And wages have not kept up. Pay has been growing only around 3 to 4% a year, barely matching short-term inflation and nowhere near the total rise in prices since 2020. So costs sprint while your paycheck jogs. That gap is exactly why so many hardworking people feel like they are falling behind no matter what they do. But here is the twist. The same force squeezing your paycheck, time and rising prices, can be flipped to work for you the moment you start investing. And that is clearest when you look at the one thing people fear most, the stock market. Every major crash, the Great Depression, the dot-com collapse, 2008, the COVID crash, and 2022, felt terrifying in the moment. But look at the long chart and one thing is clear. Every single crash eventually recovered, and the long-term trend kept climbing. Over decades, the market has historically returned somewhere around 10 to 11% a year including dividends. That is a long-term historical average, not a guarantee, and it includes some brutal years where you would have lost a lot on paper. This is why weekly investing is so powerful. You never have to predict inflation, call the top, or time the dip. If prices rise, your weekly deposit still goes in. If they fall, that same money buys more shares cheaply. When the market recovers, you automatically benefit. In a world that constantly shifts, that steady little habit becomes one of the few money moves you can actually rely on. And it connects directly to the title, because of one gap. Here is the part most people miss. Even tiny weekly amounts create a snowball far bigger than you would expect, and it starts small. Picture someone investing $20 a week. That is $1,040 a year, an amount most people barely notice leaving their account. In year one, they have put in $1,040, and with normal growth and reinvested dividends, the balance just barely starts to move. The base of the snowball is forming. By year 3 they have contributed $3,120, but the account could sit around $3,750. That extra is the snowball starting to build. By year 5, contributions total $5,200, but the balance may be closer to $6,850. Now it has real weight. The first 5 years never look explosive, and that is exactly where most people quit. But those quiet years lay the groundwork that makes the later explosion possible. Which is why the real battle is not financial. It is mental. Most people do not fail at weekly investing because it is complicated. They fail because the early results feel too small to take seriously. We are wired to expect quick wins. You put in $20, the balance barely moves, and your brain decides it is not working. We also react emotionally to noise. A scary headline, a sudden drop, a volatile week, and the urge to pause or pull out kicks in. But that comes from linear thinking, expecting smooth lines. Compounding does not move in lines. It builds in curves that barely show early and explode late. The shift is to stop asking, is this growing fast enough, and start asking, did I invest this week? One question you cannot control, the other you fully can. That tiny shift is what eventually lets your portfolio grow bigger than your paycheck, not because you outsmarted the market, but because you stayed steady long enough. Once that mindset is set, choosing what to actually buy gets much simpler. Instead of hunting for the perfect pick, smart long-term investors look for a handful of qualities. These are exactly why the funds we will cover work so well together. First, diversification. Owning hundreds or thousands of companies so that no single failure can sink you. Broad funds do this for you automatically. Second, broad exposure, which is different. It means owning different sizes and types of companies, large, mid, and various sectors, so you stay balanced no matter what is leading. Third, real historical performance, backed by companies that have genuinely grown their earnings over time, not hype. Fourth, dividend growth. When companies raise their payouts each year, those rising dividends buy more shares and make the compounding loop stronger. And fifth, low fees. Even small fees compound against you over decades, so low and zero-fee funds keep more of your money working. Put those 5 qualities together, and you get a portfolio built to survive downturns and compound for decades. Here are the 5 funds. Fund 1 is FZROX, the Fidelity Zero Total Market Index Fund. This is the core of the whole portfolio. It owns large, mid, and small U.S. companies across every major sector. In one fund, you own a slice of basically the entire U.S. stock market. And it does this with zero management fees, which over 30 years is a quietly enormous advantage. Historically, it has shown solid numbers, a small dividend yield, steady dividend growth, and strong long-term price appreciation. Its job is simple. Be the dependable, broad foundation that everything else is built on top of. Remember, all these figures are snapshots that move over time, and past performance never guarantees the future. On top of that core, we add room to grow. Fund 2 is FSMDX, the Fidelity Mid-Cap Index Fund. Instead of the biggest companies, it holds mid-sized ones. These are businesses past their fragile early days but still small enough to grow quickly. It is the expansion phase of the market. It spreads across hundreds of mid-sized companies in tech, industrials, consumer sectors, and finance, so you are diversified within that growth zone. It is a true low-cost index fund, tracking a mid-cap benchmark rather than a manager's guesses. Its role is to add a faster-growing layer on top of the steady core, with more risk and more potential reward. More growth always means more volatility, so this part can swing harder in a downturn. That is the trade. Next, a more modern slice. Fund 3 is FITLX, the Fidelity U.S. Sustainability Index Fund. It gives the portfolio a modern edge. It tracks an index of U.S. companies screened for strong environmental, social, and governance practices, with many leaders in tech, healthcare, and communications. It is also a low-cost index fund, leaning toward companies many believe are shaping the future. Over the last decade, these sectors have shown strong momentum, adding both growth and a layer of resilience. Its job is long-term growth from forward-looking sectors, without you having to pick individual companies. Just know that values-based funds can behave differently from the broad market, and recent strength does not guarantee future strength. Now we add balance and income. Fund 4 is FGRIX, the Fidelity Growth and Income Fund. This one brings balance. It holds mostly high-quality large companies with stable earnings, mixing reliable dividend payers with steady growers. Its design is to lift both sides at once, dependable income without giving up growth. One honest difference, this is an actively managed fund, not a pure index fund, so a manager picks the holdings and it charges a higher fee than the index funds. Its role is to steady the portfolio while still participating in the market's long-term climb. Because it is actively managed, check its fee carefully. Higher fees can quietly eat returns over decades, which matters for a fund you hold this long. The fifth fund is the income stabilizer. Fund 5 is FDGFX, the Fidelity Dividend Growth Fund. Think of it as the income stabilizer. It focuses on companies with long histories of raising their dividends and strong financial fundamentals. It leans towards safety and consistency rather than chasing aggressive growth, which helps steady the portfolio when markets cool off. Like the previous fund, this one is actively managed, so it carries a higher fee than a plain index fund. Worth knowing before you buy. Its job is not to shoot the lights out. It is to strengthen the compounding of dividend income year after year. Put all 5 together and you have a core, a growth layer, a modern layer, a balanced layer, and an income stabilizer. So what does that combination actually produce? To see the whole portfolio, we take a simple average across the 5 funds, treating each as an equal slice. Averaging the 5 dividend yields gives a blended yield of around 2.2%, the cash the portfolio pays you each year. Doing the same with dividend growth gives roughly 15% a year, meaning the income itself tends to rise over time. And the average annual price appreciation comes out around 9%, the growth in the value of the shares. Together, that is a portfolio designed to grow in value and grow what it pays you at the same time. But please hear this. A simple equal average is a rough estimate, and assuming 9% growth holds for 30 years is optimistic, not certain. Real life will be bumpier. With that honest warning, here's what the projection looks like. Meet Josh. He invests $5 a day, about $35 a week, which is roughly $1 into each of the 5 funds daily. By the end of year 1, he has contributed about $1,800. The groundwork. By year 10, the portfolio is projected to reach around $32,000, with reinvested dividends building real momentum. By year 20, projected to reach about $160,000, throw enough close to $9,000 a year in dividends. And by year 30, it is projected to reach around $940,000, paying roughly $8,000 a month in dividends alone. Here is the wild part. Over those 30 years, Josh would have put in about $55,000 of his own money. The portfolio is projected to multiply that into nearly $1 million, meaning over $800,000 would come from compounding and reinvested dividends, not from his pocket. That is when investments can out-earn many full-time jobs. But remember, this assumes strong returns for 3 decades, and $8,000 in 30 years will buy less than it does today. Let me be completely honest with you, because you deserve the full picture, not just the exciting number. Every figure here is a projection that assumes the market keeps delivering strong returns for 30 straight years. It might not. Real returns vary, crashes happen, and you could end up with significantly less. That projected $8,000 a month is decades away, and inflation means it will not feel like $8,000 does today. Still meaningful, just not magic. 2 of these 5 are actively managed funds with higher fees than the index funds. Over 30 years, fees genuinely matter, so check them before you buy. And the blended numbers used a simple equal average, which is a quick estimate, not a precise forecast of how the real mix behaves. Most importantly, I am not a financial advisor and this is not financial advice. It is one illustration to show how consistency and compounding work. Before investing real money, do your own research, understand each fund, and consider talking to a qualified, fee-only fiduciary. The point is not the exact number. It is that small, consistent investing, given enough time, can build something your paycheck alone never could. So let us bring it home. $35 a week is about the cost of a few coffees or one takeout meal. Invested consistently into a diversified mix of funds, that tiny habit is projected to compound into something life-changing, as long as you do not quit. The same time and rising prices that squeeze your paycheck become the engine that grows your investments. you just have to be on the right side of it. If you want to begin, open a Fidelity brokerage or retirement account. It takes minutes and has no minimum. Pick your funds, set up an automatic weekly or daily investment, even $5, so you never have to rely on willpower. Turn on automatic dividend reinvestment, then leave it alone and let the snowball build for years. And like always, understand the basics first, how risk, fees, and compounding really work, before committing real money. Pick one step and do it this week. Future you, with a portfolio bigger than your paycheck, will be glad you started small today. Keep building, and I will see you in the next one.